Hello, everybody. This is Luke Robinson with Collective, and I'm a business advisor here at Collective. And it's my job to speak to Collective members and sort of qualify them for the service to see if Collective would even be a good fit for them. And you can think of Collective kind of as an all in one, sort of one stop shop for a self employed person, specifically for S Corps. We'll handle your business formation. We'll set up an LLC if you don't have one. We'll make your S corp election for you, and we'll handle your payroll, bookkeeping, and tax filings throughout the whole shebang, throughout the whole year. But today, Collective is hosting an event we call Tax Tuesday. And what it is, it's essentially just an AMA. It's an Ask Me Anything that covers taxes specifically. And if you have any questions, please drop them in the comment section here, and we'll certainly get them answered. Or I'll do my best to get them answered. And if I'm not currently aware about what you're asking, which is very possible, taxes is a pretty complicated world, then I'll point you in the right direction and kind of tell you where you need to go. But I believe that we already have some questions that people have resubmitted. And the first one is easy enough, is what's the difference between an LLC and an S Corp? And I think that's a question that a lot of people wonder about. They've heard about S Corps from their tax professional. They've read about S Corps online, but they don't really understand them. They're a little confusing, especially if you don't work in taxes. It's kind of hard to look up something online and understand it. It really is. But essentially, how you can think about an LLC and an S Corp is really they're two completely different things. An S Corp is not a business entity. It's not a business by itself. It is not a corporation, oddly enough, right? An S Corp is not a corporation, necessarily speaking. An S Corp is a tax election. It's a way to ask the government how to be taxed. So you actually have to be a business entity like an LLC before you can even elect S Corp tax status. So the first thing you do is you set up an LLC. That is literally the first step. So you set up an LLC with your state of residence, wherever you live, and then you make an S Corp election with the Internal Revenue Service, with the federal government. And you do that by sending in Form 2553 to the feds. And what it does is you're asking the federal government to tax your LLC under the S Corp tax rules. And what that does, technically speaking, is it reduces the amount you pay in self-employment tax. And this is how. Before you make that S Corp election, essentially all of your money is subject to the self-employment tax. Essentially all of it. So let's use $100,000 as an example. And let's assume that you have an LLC set up. Doesn't really matter. Doesn't really matter if you're a sole proprietorship, which means a business without an LLC, or if you're an LLC. The taxes are the same. You pay the maximum amount of self-employment tax. Self-employment tax is a flat tax rate of 15.3%. So, for example, let's say that before you became an S Corp, you made $100,000 in a year. Before you become an S Corp, how you'd come up with your self-employment tax is you'd take $100,000 and you'd multiply it by 15.3%. All of your money is subject to it. But when you make an S Corp election, what happens technically is an employee-employer relationship is created between you and your own business. You literally become an employee of your own operation. Now, you're still the owner, of course. You're still listed as the owner on your company formation documents. But for tax purposes, you are literally now an employee. And since you're an employee, your business will pay you a wage. It'll pay you a salary, just like you'd receive if you work for someone else as a W-2 employee. But the cool thing, the cool thing about S Corps is now the only chunk of your earnings that's subject to the self-employment tax is your salary. So, for example, let's say that you make let's assume that you make $100,000 in a year, and let's also assume that you pay yourself $40,000 in salary. Before, how you'd calculate your self-employment tax in that situation is you take $40,000 and you'd multiply it by 15.3%. Before, you were taking $100,000 and you're multiplying it by 15.3%. All your money is subject to it. But now only the 40K is subject to it. The other 60K are your distributions. That's the chunk of money that is not subject to the self-employment tax. So assuming that would make around 100,000, how you'd come up with your self-employment tax savings is you'd simply take 60K and you'd multiply it by 15.3%. So in a situation like that, an S corp would save you $9,100 a year, $9,180 to be exact, a year in the self-employment tax. So, as you can see, at a certain income level, it could be quite advantageous for someone to go this tax election route. All right, and we've got another good question here. How does writing off my rent work if I am a 1099 and a W-2? Well, thankfully, writing off your rent should work in largely the same way if you were a 1099 and a W-2 income than if you were just a 1099 person, than if you were just a self-employed person. So thankfully, how you write off your rent and how you write off other sort of personal expenses, like part of your cell phone bill, part of your HOA bill, your rent, your utilities, things like that. How you do that is you measure the entire area of the place that you're renting. So let's say that the place that you're renting is, 2,000 square foot. And let's say the area that you use for business, your home office, whatever area of the house that you use to run your business, that's your office, technically speaking. And you also calculate the total square footage of that. So let's say that your total square footage of your office is 1,000 square foot. How you would come up with the percentage rate is you take 1,000 and you divide it by 2,000. So what is that? That's 50%. What that means is that you get to write off 50% of all your personal expenses. Like your rent, your utilities, things like that. And having a W-2 job attached along with it doesn't really affect that. You're not writing off, you're not taking the home office deduction off your W-2 job. It's just kind of extra income you have. You're allowed to take the home office deduction off your 1099 income, which you can certainly do. Thank you, Rissy, for that amazing question. Does it work the same way with other expenses? Yes, it works the same way with other expenses, just like it does rent. So rent, that's just one personal expense that you can partly write off for business. But things like your cell phone bill, your HOA bill, cleaning fees, part of your home office, maybe you have, monthly cleaning fees. And part of, if your office is being cleaned, then also 50% of those cleaning fees can be written off. So it doesn't just apply to rent, it applies to all kinds of personal expenses. Okay. And just a reminder, if anyone has any questions, please in the comment section, just shoot us a comment and I will answer it. Whoa. What about snacks? So Rissy asked, what about snacks? Can I write off snacks as a self-employed person? No, typically not. Snacks is usually not like even dinners, lunches, snacks, like as you're working and eating, what you're eating is typically things that you can't write off because you can only write off expenses that are directly attributed to business. So it doesn't, you having snacks, you're going to have snacks and you're going to eat regardless if you have a business or not. So in the IRS's eyes, that is not a business expense. A business expense are, things like software for your business, postage stamps, marketing costs, things like that. How is salary determined under an S corp? Excellent question, and also another kind of confusing topic here. A salary, how to come up with the salary is a facts and circumstance test. There is no objective method. And really, all the IRS says about it is that your salary must be reasonable. It must be a reasonable salary. So, what does that mean? That can mean a lot of things, right? And that's why it's important when you have an S corp to have a tax professional that's knowledgeable in these certain areas. Because any good tax professional, what they would do is they would come up with a salary sort of analysis for you, and they take in a couple things into consideration, like how many hours a week do you work, how many years of experience do you have in your business, what are comparable professionals, how much are they making in your area, how much is your business making in total. All of these things have to do and are taken into consideration when a professional is coming up with a salary analysis. So it's quite a sort of a complicated situation. I read on somewhere that we were able to write off up to 300 square foot of the home office. Usually you're able to write off 300 square foot might be a good rule of thumb, but in my experience, you're able to write off the actual business use of your home. And if the business use of your home is larger than square foot, you can write that off. What if I split my rent with my partner, separate finances? Do I deduct from full rent or just the half I pay? That is an excellent question. Just the half you pay. You can only deduct what your business is actually paying. So if someone else is sharing half of that expense and someone else is paying for it, your business is necessarily not paying for it. So you could only write off a portion of half of your rent. Great question. What if I don't rent and own a house? How do I write off my expenses? Well, in largely the same way that you do when you're renting a place. So instead of really the main difference in terms of a house that you own is instead of writing off rent, you're writing off mortgage interest. And remember that I said mortgage interest. You can't write off your principal. Your principal isn't a business expense. That's a personal investment. So you can't write off any of the actual principal that you're paying back into your house, into your loan. You can only write off your mortgage interest if you have a loan on your primary residence. So but everything else is the same. Your utilities, your HOA bills, your cleaning bills, all that. Also, your property taxes, things like that. A portion of those can be written off using that sort of square footage method that we discussed earlier. So it's essentially the same thing. The only difference is you're writing off mortgage interest as opposed to rent. Is there a time requirement needed to transition from an LLC? So technically speaking, when you have an LLC, you're supposed to elect S corp tax status by March 15th of that year. But thankfully, though, if you don't do it by that time, then the IRS will allow you to make a late reasonable cause argument. They'll allow you when you make an S corp election, or when a company makes an S corp election for you, they'll be able to sort of argue as to why you're making the late S corp election. So really, you've got until the end of the year, but usually it's a good idea to do it as soon as possible. Collective, just to kind of give you an example of what we do, we have a deadline of October 30th. If you join Collective by October 30th, we're still able to backdate your S corp election. but not if you join afterwards. The longer you wait to do it, the harder it is to backdate the S corp election. More bookkeeping work needs to be done, and it's typically more expensive. So that's what I would say. What if I want to dissolve an LLC? Zero profit. Never disclosed it in my taxes because of that. Well, and that's totally fine. If you don't have any sort of money, if your LLC doesn't make any sort of positive profit, if you don't have a positive net income, you're not even technically required to put that information on the LLC. Like if you don't owe any tax, if you're not, the IRS doesn't even require for you to claim that you have an LLC in your tax return. Now, if you have positive income, you're supposed to. If that LLC, if you make money through that LLC, then if you don't, that's leaving out income, and the IRS could come after you. But if your LLC actually doesn't make any money, you don't have a requirement to even put it on your personal tax return. You don't have to claim any income because you don't make any income. Now, in terms of dissolving your LLC, it depends on the state. In most of the states, the LLC just kind of goes defunct. It just kind of goes into an inactive status, and it just kind of eventually just dissolves on its own. It's not a big deal. There are other states to where you have to pay to dissolve it. So it kind of depends on your state. And it's just a good idea usually to research online to see what steps you need to take to dissolve an LLC. But usually you can just let it go defunct and it's not a big deal. Can I just let my S corp go defunct? That is a good question, because the answer is no. The answer is different when you have an S corp election. When you just have an LLC, you're really only dealing with your state of residence, because that's where an LLC is set up, with your state, with the state. So with the state that you live. And they usually only require, they don't typically require any sort of, like I mentioned earlier, any sort of, paperwork to shut it down or anything like that. An S corp election, though, is completely different. When you make an S corp election, you now have a business tax return that sort of comes into existence. It's an S corp tax return. It's called an 1120S. That's the technical name for it. So that is a requirement. As long as you have that S corp election, you have to file an S corp tax return, even if you don't make any money. Even if your business has a loss, the IRS still requires that S corp tax return. And if you don't file it, it's late, and they'll charge you penalties on it. They'll charge you informational return penalties. So, and then you eventually have to file those returns. So you can end an S corp election, but you can't just let it go defunct. You have to take certain steps. Let's say that you set up an S corp, you make an LLC, you make an S corp election, and you end up not making any money. And you wanted to end the S corp election. You determined that it's not worth it for you anymore. What you would do is you would, when you file your S corp tax return, you'll mark on that return that it's a final tax return. And that essentially indicates to the IRS, this is my final tax return as an S corp. Please don't require any sort of, S corp tax return requirements or anything like that. And it essentially ends your S corp. Are there any fees to become an S corp? No, there are not fees to become an S corp. Now, there are fees to become an LLC, which you have to be first before you can even elect S corp tax status. So there are fees involved. There's just no fee specifically for the S corp. So first is what you do. You'll set up an LLC with your state. And usually there's an LLC registration fee with the state. And it averages around $100. Some states charge $30 and some states charge $300. It just kind of depends on where you live. But there's usually a fee to set up the LLC. But there isn't a fee to elect S corp tax status. There isn't a fee to send in the S corp paperwork into the IRS. There's no cost associated with that. So people are usually pretty happy to hear that, to where they've gotten their LLC set up and they've spent a couple $100 to the state. They're pretty happy to hear that you don't have to give the IRS any money to become an S corp. You've talked about the benefits of an S corp. What are the drawbacks to an S corp? All right, that's another good question, Because here's what I would say to the drawbacks of an S corp. Financially speaking, they're usually, not always, but they're usually always more advantageous. You're typically saving more money when you make an S corp election compared to when you're not. Again, that's a general statement. It's not true all the time, but generally speaking, it's true for most people. Now, that's great. You're saving money, but with anything else with the IRS, there are additional requirements that you have to go through to save that money. When you make an S corp election, there are additional administrative stuff that you have to sort of take when you were just a sole proprietorship or an LLC. For one, is payroll. That's one big aspect of an S corp. Is you yourself, you're going to be on a paycheck. You're going to be paying yourself a W-2 salary. So you're required to run payroll. So you don't have to do that when you're an LLC. You have no sort of like payroll requirement. You just pay yourself and draws. You just take owner's draws. You don't have to have an official sort of payroll process set up. When you're an LLC, you have to pay yourself via payroll. Part of your money has to come through as a W-2 check. And it's more complicated. You have to have an appropriate number. You have to have an appropriate salary number. You have to know how to run payroll. It's just an additional burden to do. Also, your accounting, your bookkeeping becomes a little bit more complicated when you become an S corp. Before you become an S corp, you don't even have to track a balance sheet. A balance sheet isn't even a requirement, but it is when you're an S corp. So that's just a part of your bookkeeping now. And who knows how to track a balance sheet? Nobody besides tax professionals, let's be honest. And then also too, at the end of the year, you have an extra tax return that you have to file when you're an S corp. So it's not all, roses and chocolates. There are some administrative extra work that you've got to, put in when you become an S corp. But there's a lot of companies out there that can help you. There's companies like Collective and others that can help you. And I would advise that you do so, that you find a good company if you go the S corp route, because there's just a lot of sort of additional things that you have to juggle. And there's a lot of things that you have to worry about in order to keep you safe from audit from the IRS. So usually when you go down this sort of tax path, it's better to do so with a tax professional. Are there certain industries that don't need to be S corps? So yes, there are. There are certain industries that an S corp just really wouldn't apply to them. Because remember what I said earlier, the entire reason why you'd want to elect S corp tax status is to save on the self-employment tax. That's the whole reason. There really isn't another reason to make an S corp election. It's to save on the self-employment tax. So for example, let's say that you're a real estate investor. Let's say that you have a whole bunch of rental properties that you own and rent out. That sort of passive income isn't subject to the self-employment tax. Rental properties usually aren't subject, especially passive rental properties, aren't subject to the self-employment tax. So there's no reason to make an S corp election and have a more complicated tax situation when it isn't saving you in the self-employment tax. So industries like real estate, owning houses, not selling houses. When you're a realtor, a lot of realtors are S corps and a lot of realtors need to be S corps, but not necessarily people that own property, which should be separate from your realty anyway. If you own property, those should not go under S corps usually. Also, if you buy and sell stock long term, investments typically don't need to go under an S corp. Anything that's not any sort of industry that's not subject to the self-employment tax, that typically does not need to go under an S corp. All you're doing at that point is just kind of making your tax situation more complicated for no good reason, for no tax benefits. And then I believe I have time for one more question here. Let's see if we get one. At what income level is it worth it to become an S corp? $60,000. What we say here at Collective is at around 60 grand, that's when it's worth it to become an S corp. But that's largely part of the reason that is because of our cost. how much it cost you to pay us to handle your S corp. And at $60,000, when people elect S corp tax status, the amount of self-employment tax that they're saving is going above our fee, is more than our fee to do this. So 60K is a good rule of thumb that you can kind of tell yourself it's like a good sort of income level. Also, another number too is $80,000. That's another sort of appropriate number that people think about, and they're a little bit more comfortable at around 80K. So I'd say between 60 and 80K, that's generally when it's worth it to become an S corp. And unfortunately, that's all the time I have. I have all right. I'll answer one more question. What if I make extra money with side gigs? Can I still file them under the S corp? If all those side gigs are related to one another, if all those side gigs are kind of the same business and have the same purpose, you can't really put under multiple different side biz under one S corp. So let's say that you have a side biz of massage therapy, but also a side biz of e-commerce products. Those would need to be two separate S corps. But anyway, like I said, I've got to run. I do have a call with a collective member. And please, just kind of a last minute thing here. If you're ever interested in speaking to someone about collective or speaking to a business advisor to kind of get some advice on what you should do next, feel free to schedule a call with us. Go to our direct messages on Instagram, go to our website, collective.com, and schedule a call. And we'd love to walk you through whether or not Collective could help you and whether or not you need to be an S corp. But until then, I enjoyed it so much, like I do every week, and I will see everyone here again next Tuesday for another Tax Tuesday.